How you doing, ladies and gentlemen? Welcome to This and That. I am your host, Xander, where we're talking about this, that, and everything in between. Interesting sidebar before we get started today. Make sure that you guys like and subscribe. Make sure that you guys have the opportunity to join the membership. For those of you that are watching us on TikTok, apparently they did something to our link, but there it is. And now, for those of you that are watching our show on TikTok, you guys can click that link on the bottom right side. It should make itself worthy. Otherwise, just note that we are, there it is, live on YouTube, and that's where we come from. So I don't know what's going on with that. They made that dark. Also, we are trying to get to at least 1,000 to get our stream key. So we're at like 176. I want to get like 10,000 or 100,000. So I aim high. So make sure that you subscribe to the podcast. Give us a hand on TikTok. The rest of you that are on YouTube, Twitch, and Twitter, give me just a moment, guys. I've got for TikTok, you guys for right now can go ahead and jump in if you want to, because we're going to be talking about some stocks and stuff to try to make money today. So you guys have the opportunity to jump in if you like and give us some insight. For the rest of you guys that are on YouTube, Twitch, and Twitter, we have this invite link where you guys can click the link, approve the mic, approve the camera, jump in and say what you got to say. Can you get the link to join? Look, I just started the show, and we got fans jumping up talking about some kid to get a link to join. Yeah, I can give you a link to join if you're over the age of 18. If I do not see an adult in the green room, I am not putting that camera up there. And I can tell you right now that you must be over the age of 18. So if you are son clips, you are not getting in there. You're gonna have to get dad clips to get in here, because we're talking about stocks. We're talking about making money, how to make money for you. We're trying to help your dad find ways to set you up a trust. That way you'll be able to have money so that you don't have to work. Like I said before, clowning around on the podcast only works in the private dark members only lives where you pay for the membership. We have the different tiers of membership. We actually have collaborations on there. Exactly. You are definitely the teenager that I've seen before. I see Jason Milmore. I see you, buddy. Hold on a second. Lucas Schaefer. Oh, okay. So are you gonna clown for me today? Are you gonna clown for me? Because I'm debating on whether or not I should put you up on the screen because I can see you. And I mean, you look like you might be his teenage older brother. You're not necessarily at that mark yet. There's the young man that I remember seeing before. That's what I was talking about. See, you guys are working in pairs. How you doing, Serge? We're about to start talking about money and making money for you. So I just wanted to make sure, because they got some people who can get in here if you guys wanted to click the link, approve the mic, approve the camera, get up here through StreamYard. But the rest of you guys that are here from TikTok side, if you guys wanted to get up here and give you a shout out to a friend or family member or whatever, or actually talk about the topics of the day, then you guys can request an invite. I can bring you guys on, or I can send you an invite and you guys can jump on and we can have an in-person live discussion about topics related. Today we're talking about business. Tomorrow we're going to be talking about taxes. The next time we're going to have some relationship topics. We got something different, a little bit different every day. We kind of got it mapped out for the next at least 15 days. We typically go 30 days, but kind of been working on getting the guest up onto the show. So I'm trying to leave some blank spaces to book some people. So I don't know if everybody knows everything about this. So I'm going to start talking to you guys about stocks, where we're going to be really talking about the ins and outs of what it is. And then we're going to actually start talking about some of the things that are different between what you know about stocks and trading and what these guys that are telling you, oh, buy my seminar and I'll help you make money in less than an hour. And yeah, there's some stuff that y'all don't know. So instead of me doing one of those seminars where it's like, oh yeah, give me an X number of dollars and I'm gonna tell you what the secret is. Nope, 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 nope. I am not concerned with I'm just gonna tell you what's going down. So let's get started so that I'm not wasting your time. So first of all, the stocks that people talk about, the stocks that are on Wall Street, the Nasdaq stocks are the ones that represent the shares of ownership of a company, and that is going to be the security that gives the stockholders claim on the company that is earning the money. So the money that's being made by the company, that is the stocks. The shares is how many of them that you actually have. Now you have different types of stocks. So if you are a small business owner or you're deciding to start up a business and you wanted to build some startup capital for your business, and stocks would help you do it, there is a document that you guys could actually use. I'm going to talk about that another day, that can help you with getting these stocks. But you have different types of stocks, and this is something that you want to think about, because when you're trying to get investors, you want to make sure that you're not giving away the authority of your company. When you're doing that, you want to do preferred stocks. When you're doing preferred stocks, that is when they do not have voting rights over your company. They have priority for dividend payouts, which means that if you have a limited quantity of dividends to pay out, the percentages that when you have a limited quantity of money to pay out, but you have an obligation to pay out dividends, the first person that gets paid is the preferred stockholders. The common stockholders get it next, but these guys get voting rights, which means that if somebody buys a large quantity of stocks or a majority share of your company, they can actually vote you out. And that's why I wanted to talk about that real quick. And so you have common stocks, you have preferred stocks, and then you also have growth stocks. Now, growth stocks are going to be stocks where people are going to invest in your company in large increments, knowing that the dividends are lower than the investment. And we're going to be talking about growth stocks in a minute, but it's the idea that in the long run that the ends will justify the means, and they will be seeing larger profits in the long run. Growth stocks are stocks where you're going to invest in a company for the sake of the company's future, not for the sake of dividends today. You're going to have some income stocks, and income stocks are going to be from companies that are more stable. These are going to be stocks that are going to be paying you consistent dividends if you have a certain percentage of stocks, and those income stocks are going to give you usually quarterly. So we're going to be talking about income value stocks in just a second. You have value stocks that are going to be stocks that have a low investment rate but a higher return value. We're going to be talking about those in a minute. And then your blue chip stocks, which for the most part are shares in a large company that is well established, something that's been around for a long time, like Wells Fargo or something like that. So how stocks work: when a company sells stocks, it does that to raise money. So if you're starting up a business, you can sell stocks to raise money or expand. So if you already have a well-established business, you have money coming in, and you want to get you some extra income in, and you want to be able to use that income to expand your business, buy another location, or buy you some better equipment, or whatever the case may be. This is going to be the best way to do it. You sell stock shares of your company. Depending on the type of stock shares that you sell, people will give you money, and it's not going to be based on a financial background check from a personal guarantor. You're not going to have a certain quantity of money down to get it, or anything to that effect. You just have a certain quantity of stocks, which you can actually give to an agent to sell off for you. They sign these people up for your company. Then your company gets the money from those individuals. And then based on whatever contract that you created for those shares, they are required to pay you a certain quantity of money that or no, you are required to pay them a certain quantity of money out of the money they paid you. That's the way that's supposed to be. Kind of got confused there for a second. I was looking at something on the screen. So what happens is that these stocks are typically bought and sold on the stock exchange, and this you have the NYSC or the NASDAQ, which is usually personified as NASDAQ. And these are going to be ways that you're going to be able to make money for your business until your business starts turning over money. Now, if you are a person that's just trying to make a little bit of money, this is one of the things that you want to get into. But those people who tell you when those people are telling you that you can start up, join them, and then they'll take you down this path where inside of a couple of hours you'll be able to trade like a pro, and you'll be able to turn over a few $100s in less than a minute. That's all lies. It doesn't work that way. It's a lot. There is no short way to get to flipping money. It just doesn't happen. But when we start talking about investing, the benefits of investing stocks is that you have potential capital gains as the stock prices rise, and you have possibility for incomes from those dividends, which also come with lower tax rates on long-term capital gains because you have deferred taxes on long-term capital gains. And then depending on which stocks that you invest in, you have some that have exemptions from taxes after it has matured, depending on what kind of stock options that you get. Now, when you're dealing with stocks, you're dealing with risks. And the risks of investing in stocks is that you're going to have stock prices that can plummet like we had with COVID. And that means that you could end up losing all of your money. You can have stock options go into negative where they didn't go bankrupt and sold everything off. And every dollar that you put into it and all the money, all of the profits that you gained is all gone. And that's when you start seeing people like jumping off of buildings, MC Hammer broke, stuff like that. You have companies that can go bankrupt and they leave the shareholders with literally nothing. That's why it's a very high risk situation. You have stock values and dividends that can be volatile, which means that you can buy into a stock that has low dividends where you're putting in a ton of money, but you're not really getting anything back from it. And you're spending more money than you're making. So you got to make sure that you pay attention to these particular aspects of things. Now, when you're trying to buy stocks, you're going to go through direct stock plans from companies. Some companies have platforms that are set up where you can buy the stocks offline from places like Acorn, Stash app, and that's STASH, not Cash app. Stash app is a cell phone app that you can download to your phone that does percentage investments. It doesn't act, it's like a fractional investing app that allows you to put a little bit of money up. It bundles together certain types of shares that are beneficial depending upon your trading style. And it's kind of like a trading for beginners kind of app that allows you to put a little bit of money in a lot of places and turn you over a little bit of an interest, which actually can guarantee you more of a gain and less of a loss, depending upon whether or not you're doing low risk or moderate risk trading. But the high risk trading still is going to have room for loss, but you're going to be dealing with the average between losses and gains, where you might have less gains than you have loss, but you're less likely to see loss because of the packages that app puts together for its potential clients. But you're not actually, with Stash app, selecting each individual stock that you're going to be investing in. It only actually bundles together a type of stock, and then you pick similar stocks. So like if you're into technology, you'll pick the technology shares. If you're into automotive, you'll pick the automotive shares, and it'll just have it all bundled together. So like I said, it's investing for beginners. They take their cut, you get the difference, and you've turned yourself over a profit. Now, when you're dealing with dividends, this is reinvestment plans where you're going to have stocks that are going to mature with value. You're going to be able to take the dividends, the payouts, and then buy more stock with the dividends. That actually happens because this is different from Bitcoin, because while Bitcoin is somewhat considered a stock legally, it is actually a currency. It's not actually a share value in a company, because Bitcoin is not a company. Bitcoin is money. So it's kind of different. It's a currency. But when you're reinvesting into the stocks, it's like you take the profits off of buying and selling the stock, and then you use that to buy twice as much stock. Sometimes twice as much stock in the same company, because if you buy when the company shares are down and then sell when the company's shares are high, then you can go back and buy twice as much, or however much your increase was, buy more than that in shares when the company is back down again, and then allow it to go back up again. And that's typically something that happens with the day traders. So that's one of the reasons why I wanted to talk about this, because when you start talking about trading stocks for day traders, when we're dealing with this little guy, this book right here, when we were talking about how to retire on dividends, this guy's going to be telling you guys about stocks and shares. And I thought that it would be a good idea for us to really talk about stocks, because if we're really talking about stocks, then we're really talking about the fact that, you could, in fact, draw back from either day trading or buying and holding a dividend paying stock that will potentially allow you to receive certain quantities of capital. And if you are doing reinvestment, where you're taking the profits from the dividends and you're putting them back into the stock, then you're in a situation where you're over time, if you've got a 20-year plan, that by the time you get to year 10 or year 15, you're drawing back more than enough money where you can just kind of float, where the interest off of all of your investments is making you enough money to live, or more than enough money to live, where your principal is generating more revenue than you're spending. And that's where we want to get to. So one of the things I wanted to talk about was the income stocks. And these are a type of stock, a type of equity investment that provides shareholders with a regular dividend payout. And some of these payouts are typically going to be quarterly. Now, people are going to talk about that on a regular basis when they tell you, oh, hey, go buy these top 5 dividend paying stocks. They don't actually tell you that these are income based stocks, where these are stabilized companies that's been around for a long time. They're not trying to expand. They're just plateauing, but their stocks are up there. You can buy shares in the stock and they will pay you dividends towards the shares that you buy. The more money you put into them, the more money they've got to circulate. The more money they've got to circulate, the more money they make. The more money they make, the more dividends they give back to you. So those are income-based stocks, because it's pretty much just buy and hold. Now, those income-based stocks, they typically pay quarterly, which means that you get the money now. 3 months later, you're going to get money as long as your money stays in that stock. That is not the type of stock that you're going to buy and sell. That is the kind of stock that you're going to buy and keep. The kind of stocks that you're going to buy and sell are going to be the kind of stocks that are not necessarily dividend paying stocks. They're going to be stocks that are going to hold a value, and then you're going to sell it when the value is higher and buy it when the value is lower. That's going to be the ones that you're going to do the day traders on. The income bearing stocks are going to be the stocks that you're just going to hold. And as long as the stock market is fair, you're going to be getting dividends from that company. Now, those people who tell you to set up a plan where you have income bearing stocks, where you could basically go on autopilot, buy this stock, and the trust will give you, if you buy the stock, you put it into the trust, and the dividends are given to the trust for every 3 months. If you find 3 different companies or 3 different sets of companies where they pay quarterly on different months, where one might be paying out on January and April and August, another one might be doing February, May, and September. Another one might be doing March and July and October, something like that, where every 3 months you're getting money from one of the companies that you invest in, but you're technically getting one payment per month. It's going to be a different value because these companies have different cash values. But if you're getting a different payment from a different company every month, if you're quarterly, you've got 4 quarters, you got 3 companies, you're going to get every 3 months, one of those 3 companies is going to pay you out. Now, if you stack companies that are income-based stocks, where you have 2 or 3 companies that are going to pay out on January, 2 or 3 companies that are going to pay out on February, 2 or 3 companies that's going to pay out on March. Now you're getting 3 payments in January, 3 payments in February, 3 payments in March, and every quarter, those companies are going to rotate out the same. They're all going to drop their money into the same trust. The trust is going to get residual income monthly. You'll be able to utilize that residual income monthly to cover the costs and expenses of certain things like property taxes on any shares that you have, or anything to that effect. But you will also be able to, any type of cost or expense like the mortgage or anything like that that is being covered by the business that could be technically utilized as a tax write-off, can then cover the taxes of the property where the property is not actually costing you money, and the shares are not costing you money, and that profit that you got from the shares is going to wash itself out with the debt that you have in the trust, with the expenses that you have to pay. These are some of the things that people utilize in order for the rich to get richer. So this is an autopilot way where you start buying into these companies and then reinvesting the dividends, and continue to reinvest the dividends to continue to increase the principal, so that you can continue to have a larger portfolio that over time will continue to pay you monthly, but you will eventually be able to overshadow your standard of living, where you're once you start making more than 70% of the cost of work, or like whatever you're getting from your work, you can quit your job, because you can make that other 30% up, and then you can actually start focusing primarily on this new thing that is bringing you more than 70%. That's what you want to do. Now, one of the things that you want to pay attention to with a income-based stock is you want to look at the fact that you're going to be getting regular dividends. So you're going to be looking at a stock, you're going to be paying attention to the information on that stock, where it will be able to inform you that that stock is going to pay consistent dividends, and which portion of the company's profits are distributed to the shareholders. So you'll know if you're a preferred, where you're going to get paid first, or if you're a common, where you're going to get paid second, regardless of whether or not you got voting rights. And then you're going to be able to determine if the dividends are typically paid quarterly, and if you have companies that may pay them monthly or annually, because you have some companies that might pay once a year, some companies that might pay smaller amounts every month, and some companies that'll pay quarterly. If you get 4 of the top 5 or 3 of the top 5 that are paying quarterly, and then you get some that pay annually, and then you get some that pay monthly, and then you get some that pay semi-annually, between all of them, your portfolio is still giving you a monthly residual income, and that is what you're looking for. You are looking for a monthly residual income from the full totality of your trading portfolio. So ladies, if you guys are really wanting to start talking to your fellas, instead of you talking to your fellas about insignificance, you need to be able to talk to your fellas about asking them straight up, hey, like, what's your stock portfolio look like? And you ladies got to be able to answer that question. Like, do you have a stock portfolio? Like, what's your credit score look like? Like, what's your investment portfolio looking like? Like, and which like your investment plan is a little bit different than what kind of money you holding on to that's turning over dividends. Like, how are you investing your money? Where are you investing your money? Like what's your 20-year plan? Like, what do you have a 20-year plan? What's your intentions of retirement? Like, are you going to work until you drop, or are you going to, you know what I'm saying? So really, when we start talking about this kind of stuff, and people typically like controversy, as opposed to coming onto the show and talking about, oh man, look, we're gonna we're gonna make some money. People like to talk about controversy instead. And really, if you focus your mentality on actually making yourself some money, that's when you really got to start changing and saying, hey, I'm barking up the wrong tree, because the person that I'm talking to is, if I give them $1,000, they'll spend it. I mean, you find a better person if you give them $1,000 and you'll save it, but you get the best person when you give them $1,000 and they invest it, where they're trying to bring back 10 to 20% interest on that $1,000, where they can spend some of the interest and still give you back some of the interest while holding on to the principal. You give somebody $1,000 and they give you back $100 a month. That's a person you want to talk to, versus a person that you give $1,000 to, and then they're going to turn around after they spent that $1,000 and they're sitting there with a handout. Just think. Now, another thing that you're going to have to pay attention to is the stability and determine whether or not there is low volatility in this particular company's stocks and options. You're going to be able to do that by looking at the trends of this particular company's trading success rate. And they typically show you that. You can find that on TD Ameritrade. If you're going to trade yourself on TD Ameritrade, you can pay a stock agent to help you with trades. You can look at the market trends of certain stocks if you're buying stocks on Acorn or other trading apps, and you'll be able to see like the volatility. Because if it's highly volatile, you're going to see a lot of highs, but you're going to see a lot more lows. It's going to look like a heart monitor of somebody that's having a stroke, versus a more stable stock market that might not have that many fluctuations. Or it's on a steady increase. Even if it does have fluctuations, it's on a steady increase with those fluctuations, where the lows are higher than the previous highs, as opposed to it having a peak one day and then it's in the negative the next day, kind of thing. It's highly volatile. If you buy in on the wrong day, you're buying too high, and if you sell on the wrong day, you're selling too low and undercutting your profits. That's the type of stuff that you need to make sure that you pay attention to. So companies that issue income stocks often have stable earnings, which means that they're not dealing with some rainy days where they're not making any money, and they operate in mature industries such as utilities, telecommunications, and consumer staples. The stocks, these are going to be the type of stocks that are going to be less volatile compared to the growth stocks. And growth stocks are going to be attractive, but income-based stocks are more attractive and risk adverse to investors. So that means that you're going to like those. If you can afford to get you an income bearing stock, you want to do that before you go running out there trying to grab you a regular stock. You see what I'm saying? You just don't want to, you don't want to run that route. So dividends from a growth stock, you're going to be dealing with stocks that are not only providing regular dividends, but also increasing dividend payouts over time to adjust for inflation or reflect profit growth. You like those particular types of stocks because if you have a stock that's going to pay you a percentage of dividends, but that percentage of dividends is going to be subtracted by the value of inflation, you're actually going to get a lower and lower return every year. But if you have a growth dividend thing, then you're going to have a percentage increase even with inflation, because when you have a dollar is only valued at a dollar because the value of a dollar stays the same. But when you say that an item is worth $100 and then with inflation that item is worth $1,000, your $100 doesn't go as far. So if you were supposed to get a 10% profit off of this thing, but now it costs more, you get a lower profit. That's inflation negatively impacting your stock. But if you're going to get an inflated percentage rate, even though there is a deflated profit margin where your inflated and percentage rate is still going to give you the same amount of money every payout, you're actually not negatively impacted by your inflation in that particular product. So it's always good to make sure that you're looking to see whether or not your interest bearing account, your income stock, is actually a dividend growth account or if it's just a regular interest bearing account. Then you have large cap companies. Those are going to be the ones that income stocks are often issued by large cap companies with established financial infrastructures and stable income, just like Tesla, IBM, AT&T, stuff like that. You see Ford and Dodge. They were actually doing pretty good last year, and you start seeing Coca-Cola and places like that that are starting to show large caps. Now, the defensive nature that you're going to be dealing with is these stocks are considered defensive because they belong to industries that remain essential regardless of economic conditions. Now, the defensive nature ones are going to be things like food and energy and utilities, because people always need to eat. People always need utilities. They always need energy. They always need electricity, lights, water, gas. These are going to be those index 500 style scenarios that you can invest in. And it says W for Taylor. I see you, Taylor. And Clips doesn't believe me. That's fine. You don't have to. Fact is, if you were old enough to know anything about the stock market, you would definitely be like, yep, he's on the right path. So the investment appeal. One of the things that's going to be really attractive about investments is the steady income. You're looking at the dividends, you're looking at the payout margins, you're looking at the consistency of the payout. Your ideal for investors is seeking a reliable income stream, such as a retiree that is looking for passive income. Your portfolio diversification is going to be adding stocks that can balance the risk and the reward in an investment portfolio. So you might have a larger quantity of low income stocks versus the high income stock. I mean the low risk uh, regular interest bearing stocks versus the high risk, where the high risk sometimes has a loss. And that's what I was telling you about before. If you have a stash account, the stash account has some high risk mixed in with some low risk, where the low risk has guaranteed interest improvements on a monthly basis, on a weekly basis, and the high risk sometimes has a loss, but the loss is offset by the gain. So the overall difference between a stock with a loss and a stock with a gain, if the stock with the gain is higher than a stock with a loss, you have an overall positive portfolio. So if you have one stock that dropped 10% and one stock that gained 50%, where the 50% increase has a higher value than the 10% decrease, then your portfolio had a higher balance, had a higher increase. If you have high risk stocks that have higher values, where you have $100 high risk stocks and $10 low risk stocks, your low risk stock gets a 50% increase and your high risk stock gets a 40% or 20% decrease. You're losing way more money than you're gaining, because your low risk stocks don't have as much to gain as your high risk stocks have to lose. And this is why you have to pay attention on how you structuralize your portfolio, because you want to have more low risk high reward stocks than you have high risk, low reward stocks, or volatile high risk stocks that might get you a good reward some of the times, but cause you to have a net zero or a loss more than you have a gain. So the inflation hedge, you want to have regularly increasing dividends that can help protect against inflation, because that means that as those stocks, as the inflation increases in, uh, as inflation increases the losses in your dividends, you want to make sure that the increase in percentages is going to continue giving you the same quantity of money on a regular basis. And this is one of the reasons why you have a big business that is going to raise the expectations for your workload, reduce the quantity of workers, put in a larger quantity of uh, work on a smaller quantity of workers to increase the quantity of profits, reducing the quantity of work hours. They can't reduce the quality of the product, so they have to either raise the price of the product, or they're going to have to reduce the workload of the of the work, reduce the workers that are performing on the workload. You also have scenarios where they're going to replace the manual labor with the the machines, because the machines cost less. So with one human being paid $25-$30 an hour versus one robot being paid $25-$30 a day, they can replace 100 workers with 300 robots and only have to pay them $35 a day for 300 robots, instead of paying 100 workers $35 an hour. Still a profit all the way around, because now they're making 100 times more productivity with uh, uh, 1/10 of the cost, and they have less loss, they have less theft. So all of that makes more sense. Now you're looking at certain companies. I told you before, companies like Coca-Cola and Walmart are known for their consistent dividend payments and are popular choices among income stock investors. And you also have income stocks that are favored by investors who prioritize steady incomes over capital appreciation, offering and capital appreciation is going to be holding your money for a long period of time just to let it mature and then get larger payouts after the fact, which is like long-term investing. You want to be able to invest now and start getting money every quarter, or invest now and start getting money back every month. So the consistent investors are going to be preferring that more over the capital appreciation, which is offering a dependable way to generate cash flow while maintaining a relatively low risk profile. Now, value stocks are going to be different because value stocks are shares of companies that appear to be trading at a lower price relative to their fundamentals, meaning their earnings and their dividends and their sales is going to be higher than the cost to buy into the stock. They are considered undervalued by the market. These people are going to have lower price to earnings, which means they're going to have lower cost to buy it versus the amount of money that you get back to it. So the price to earnings ratio is going to be lower. The price to book ratio is going to be lower. And then they're going to have high dividend yields. And they are often found in established industries like financial institutions, healthcare, industrial, and energy-based companies. So these are some of the places that you should probably look when you're trying to get you some stocks and trying to invest and build yourself a stable portfolio. So company profiles, usually well-established and mature companies, are going to have slower growth rates, but often financially stable. They're going to often pay dividends as they have less need to reinvest their profits for growth. You're going to be looking at investment strategies where your value for investing in aims towards capitalization on market inefficiencies. This is going to be something that we're going to be talking about in a minute, where you're going to be looking at some of the pitfalls in the market, and then you're going to be betting against the foreseen pitfalls. Now, investors are going to look for stocks that they're going to be able to trade below the intrinsic value, and then so this means that they're going to buy something that is valued lower, that is lower than its value, and then sell it at a higher valued rate. That way they turn a profit. And some guys can hit it big, like hitting a lottery ticket, where they can buy something really low, sell it really high, and get boatloads of money off of it. Or there could be a spike in the market while you're in possession of it, and then you sell it at its peak or reasonably close to its peak, and then you're going to be able to receive a massive quantity of gains. The goal is to benefit when the market eventually recognizes the stock's true worth. So you're buying an underrated stock before the stock starts gaining heat. And then when the stock starts gaining heat, then you want to sell it. That way, the difference between when you bought it and when you sold it is substantial. And that difference is the interest earned off of stock trading. That's going to still be daily traders. Those of you that can make money, you can literally make money every day off of daily trading if you know what you're doing. But I'm going to talk to you guys in a minute about why that's not as easy as you think it is. You're going to have comparisons to growth stocks, where the value of stocks are generally considered less risky than the growth stocks. So your value stocks, not so much as risky as growth stocks, because growth stocks, you're putting money into a company's expansion so that when the company stops expanding, you're going to get higher profits in the long run. The value stocks, you're going to have stocks where the company is not expanding anymore. They've plateaued. The cost to buy in is low because they don't need the money, and then the dividends are high and the payouts are frequent. Once the stock market reflects that, people are going to start buying into that particular product, and then that stock is going to start becoming more valuable, which means that the cost of that stock will go up. Then you're going to be able to sell your stock while that particular stock is hot and turn your profit. And you're going to often see the performance better during economic booms due to their cycling nature. So you're looking at a stock market, the growth stocks are not going to see as much explosion in a higher successful market, whereas the value stock will see more success in a higher successful market. A growth stock would see more success when the market is bad. When the market is good, a value stock would be seen as more successful. So you want to kind of take a look at this. And when you look at value stocks versus growth stocks, they have alternated in output performance over time since 2007. Growth stocks have generally outperformed value stocks with some minor exceptions. So the advantages are that you're going to have potential capital appreciations if the market recognizes the stock's value. But if it doesn't, you're just not. And then you're also going to be able to see steady income through those dividends, even if it doesn't. And then it's going to be less affected by the volatility of the market. So, like if COVID negatively impacts your stock, you're not going to really see that much of a crash in your particular stock because your stock was undervalued. So it's not as negatively impacted as other stocks. Now, diving into these growth stocks, the growth stocks are shares in companies expected to grow their revenue and earnings at a rate significantly above the market average. And you're going to see that a high growth rate is going to see stocks associated with companies that exhibit rapid increasing in sales, earnings, or cash flow, which with the Tesla Cybertruck, you're not going to see that often. But they're supposed to be putting out another 6,000 of them this month between now and December, where they're out of the 2 point something million people that are on the list, they're only putting out about 5,000, 6,000 a year, not a few 100,000 a year, like less than 10,000 a year. So at their development rate, the 2 million, it's going to be 15 years before they reach everybody on that list. So Cybertruck is going to be one of those trucks that's so far on a back order. If you wasn't on the reservation list, you're never going to see that truck brand new. You'll probably get it used where somebody bought it, didn't like it, put it up for sale, but they didn't like it and put it up for sale. You're not going to like that model put up for sale. Now, one of the things I thought that was funny about the Cybertruck was that while that particular stock took a turn for the worse when the shareholders weren't getting paid out for a little bit, the fact is that the Cybertruck was advertised in its debut to have a certain quantity of success, and then the stuff that they advertised in the debut, it didn't have in the rollout. Some things like the bulletproof glass didn't happen. They have recalls on the windshield cracking. The durable frame isn't really durable because it kind of just like falls apart. It's supposed to be bulletproof, but you can't put heavy objects in it without bending the frame. There's a lot of things that they advertise that isn't quite up to the expected standards of when you've seen the truck in its initial debut, which really deters you from, if you are on that list, from actually cashing in on that particular vehicle. But guess what? Since you are on that Tesla list from 2019, 2021, whatever, since you are on that Tesla list, more often than not, they offer you the opportunity to dive off that Tesla list and potentially go buy you a different Tesla. So since they have that one Tesla that's up there, that is Lucas says hello. So how you doing, Lucas? Yeah, we're not going to put none of those comments up there, buddy. So so if you're still on that Cybertruck list and you're like, I ain't really worrying about it, they'll take the $100 that you put towards your Cybertruck reservation and put it towards you purchasing a different vehicle. So that $30,000 taxi cab that they offered you, you could potentially get that instead of the Cybertruck. And they're not going to really give you any discounts on it. Sometimes they do offer you some discounts, but they're not really going to offer you that many discounts on it. But they'll definitely prioritize your ability to get something because you are on a waiting list from like 5 years ago, going on 6 years ago. This helps them generate revenue. Remember, the Cybertruck was supposed to have the autopilot feature. It doesn't have an autopilot feature. You have to manually drive it. It just has buzzers and sensors and everything like that that tells you that the vehicle is not doing what it's supposed to do, but you still have to manually operate the vehicle. That's one of the things that I was telling everybody about. It's like, I'm not even going to try to look into it until it starts driving itself. Since he made the car that drives itself, which competes against the Rolls Royce that drives itself, the fact is that he would be able to take that particular data and then put it into the autopilot system that's supposed to be in a Cybertruck, make it a quad motor. That way you've got the 4-wheel motion with the crab crawl, all the stuff that they talked about. That generation, which is probably the second or third generation of Cybertruck, you're still going to be on the waiting list. They still would not have gotten past the first 100,000 people, but you would be able to Okay, that's trolling. Uh, he said Cybertrucks have emission issues. Well, the issue with the emission issues with Cybertruck is that there are no emissions, dude. There are literally no emissions. But either way, because we were talking about stocks, but I kind of wanted to tell you when we start talking about like investments in stocks and stuff to that effect, you think about the fact that something as simple as the product that you're investing in having complications with development, having delays with productivity, but you also look at other products that that company is developing that has massive success rates. You're looking at the losses of that company is offset by the gains of that company, so that company is still going to be able to give you royalties. So investing in Tesla is still a good thing, and so is iPhone, Samsung, uh, T-Mobile, Ford, companies that are just they're forever doing something that's going to make a little bit of extra in there. Dodge, these are some companies that are always going to have something happening to them. Now, when you're looking at reinvestment strategies, your growth companies typically reinvest profits back into the business to fuel further expansion rather than paying dividends to the shareholders. And that's what Elon was doing when he was trying to build the gigatech company in Texas. He was reinvesting instead of paying the shareholders, and shareholders were pissed off. But it's going to pay out now because he's going to be dealing with lots of money off of those $30,000 robots, the $30,000 cars. Like there's going to be more stuff that's going to get bought now. So there's going to be more profits that's going to happen on the back end. So for those people who put money in and their investments were deferred, or their dividends were deferred, those dividends with interest are now going to be paid out at a later date and time. So the ends justify the means for you. So with that being said, I say, you always want to pay attention to the companies that you're investing in, but you can do your research and typically find the top 5 or top 10 uh, uh, dividend paying stocks, the cash stocks, the investment stocks where you're going to invest in those. They're going to pay you out money on a monthly basis, and you want to look at those and then see what they got going on, what their payouts have been over the past 3 months, or since they're paying out quarterly, you want to see what their payouts have been over the past 12 months, and then you want to compare that to some other companies. You want to look at their return rates annual, and then you want to grab a few that are good for you. Hold on to a few of them, circulate them out, make sure that you're able to take the profits off of one, put it into another, and just keep bouncing that back and forth until you have a massive quantity of successful dividends. Max, good to see you, Max. But yeah, so in order to get into the show, you got to be over the age of 18. So while we do have those links in there, I encourage you guys to get into those links, but I also encourage you guys to get into those links as adults. So when I put these links back in there, let me see if I can throw that link back in there. So for those of you who didn't see it, if you approved the mic, approved the camera, it will give you the opportunity to get in there, but you will only get on the show if you are over the age of 18. So if you are not, I am sorry to say, buddy, I will not put you in there. Red Void, it is good to see you, buddy. He just jumped in out of nowhere, slid in. We're doing pretty good today. The market valuation, that's something that you're going to need to be paying attention to when you're trying to buy stocks. And one of the reasons why I want to talk to you about market valuation is because these are some of the things that are going to be leading to that one. This is a lot of information to take in, right? And I am nowhere near halfway done. And this is all of the information that you have to pay attention to when you are trying to buy and sell stocks. So when these cats tell you you can flip money inside of an hour just partnering with them, it's a lie. It took me 48 minutes just to tell you what it was and how to do it. We haven't even gotten to the most important part, the shortest hand of investment trading. We haven't even gotten to that part yet. Mr. Fireball. Recognizing you guys that are diving in. But yeah, we're gonna keep on moving. The market valuation is going to be growth stocks often trade at higher price to earn values compared to value stocks, reflecting investor expectations for further growth. So they may appear expensive based on current earnings, but they're valued for their potential to generate stability in the future instead of right now. So that might be something like I said before, Tesla, you might be spending a lot of money on Tesla stocks to get in, but when they do pay out, they pay out a lot. You just got to be patient and wait for it. Now, risk versus reward. You're going to be dealing with investing in growth stocks can be risky as their higher valuations depend on continued growth. But now, how you going to do that? You're going to literally try me with an audio file. You're gonna put a video on repeat of what looks like a Lara Croft. That doesn't really work for me, guy. That doesn't work. And it still says Lucas. So just because you say Larry Francis, the Larry Francis iPod on Lucas Shaver's email, I can still see who you are. That's why you had to verify your account with YouTube. Sometimes I get brief entertainment from those people who pop in. But now you guys know, yeah, you can click the link, approve the mic, approve the camera, and once you jump into that green room, I will see you. And if you are appropriate and about trying to make money and do business and being appropriate, then you will get up on the show. We have had some people on the show. We had Joe on the show, which is Clips' dad. We had Joe on the show. They were at the townhouse having a holiday. It was a B&B, Airbnb. So we do have people that come up onto the show. We just have to make sure that you are appropriate, which that is not appropriate. So if you're looking at a company that fails to meet growth expectations, the stock prices can decline sharply. That means that your people have invested in the stocks. The stocks were doing good for a while, and now they're not. And now you start seeing people like bailing out, and the dividends aren't what they thought they were going to be, and they just kind of like remove themselves from that particular company, chalk it up as a loss, go get something else. You're going to see examples of this. Companies like Amazon, Apple, Netflix. They have been considered growth stocks due to their rapid expansion and market dominance, because everybody's got Netflix, because Netflix replaced Blockbuster and Hollywood Video. And so many people value Apple over Samsung, even though Samsung is a better quality product. People are still going after Amazon and Amazon Prime, even though Temu is producing cheaper products in mass quantity and giving you a $5 return if your product is late for delivery. Whereas Amazon is just like, you got to wait. You got to pay extra money to get next day delivery when you're not even really getting next day delivery. You're getting like somewhat next business day delivery, which it actually starts the day after the day that you asked for it, and you get it the day after that. So it's not really they're not going to overnight. If you buy something right now, it's 10 p.m. Eastern Standard Time. You buy something right now, it is not going to be at your house in the morning. You buy something right now, they're going to ship it out at 8, 9, 10 o'clock Eastern Time tomorrow, and then you're going to get it the next day. So you're paying all this extra money for literally nothing. But Temu is one of those companies that'll give you the opportunity. Well, yeah, you wait for it to get there, and whenever it shows up, it shows up. But each time a product takes more than, I think, 7 to 10 days, you get $5 back. You order 10 things, you just got $50 back. There's going to be some situations where there's something that you want to buy that is cheaper than the $5 back that they keep giving you every time you order something, because it takes 3 weeks for you to get stuff, because a lot of it is being shipped in from China, Taiwan, Tibet, Thailand. Moving on to investment considerations. And we're part of the way there. Are we part of the way there? Yep. We're part of the way there. So we're almost like halfway through the list of things. So, okay, radical question. He asked, what about Bitcoin stock? I'll play to that question. What about Bitcoin stock? Bitcoin stock about 19 months ago was at 20,000. Bitcoin stock last month was at 73,000. Bitcoin stock is on a decline this month. It's down to about 68,000. Typically because the top 1% sells their Bitcoin, sells stocks so that they can use the interest off of the stocks so that they can buy gifts for their family members. So those Halloween decorations, the Halloween costumes, all that stuff costs money. They're going to sell stocks so that they can do stuff for the holidays. So you're always going to see in Bitcoin, you're going to see a stock depreciation 1 to 3 weeks before a holiday. You're always going to see that. So with Halloween, stocks started declining closer you get to Halloween. Halloween is next week. Now, it's going to start going back up a few days after Halloween. But you got to remember, Thanksgiving is a couple of weeks later. So even though it might go up a little bit, it's going to go down a little bit more because of Thanksgiving. Then after Thanksgiving, it's going to go down again for Christmas. Now, right after Christmas, you're going to start seeing it go back up because a lot of people are going to be dumping their money into it so that they can catch the tax deductions from quarter four. Little Smith trying with a different email. Smart. However, I still got to see who you are, buddy. So when they put their money back in at the end of or towards the end of quarter three, because as long as you reinvest all of whatever you made or more than what you got back, you have a loss in comparison to a gain, so you don't have to pay taxes on it. And you're still looking at a scenario where if you get your money for Christmas between the 1st and the 20th, and then you decide to dump a bunch of money back into your stock on the 28th, then you're still going to be able to get that tax deduction or that avoidance of having to pay on those dividends. Now, you're going to see when the stock in January starts rapidly declining, because in quarter one, you can cash out on all of your stocks as long as you put all the money back by quarter four, so that you don't have to deal with that tax, that 20 to 30% tax, depending on whether or not you're an individual, an LLC, a C corporation, or an S corporation. Now, he asked, will Bitcoin be a good investment? Bitcoin has always been a good investment. Bitcoin is one of the most volatile stock markets to get into, which is one of the reasons why it is better for you to trade with Bitcoin for beginners if you're using trade bots like Pionex, because if you use Pionex to trade with, which I should be putting affiliate links up here for this part, but when you're using Pionex to trade with, then you would be able to do microtransactions throughout the market 24/7. And then you could just check the app ever so like 3-4 times a day and shave off the interest when the market is high, and then watch the market when the market is down. And you can have, I do believe on Pionex, up to 10 or 12 free bots where you don't have to pay for the bots, and you just pay for the transactions that they do. And it's 0.05% or 0.05% per transaction that you have to pay for. The per purchase and per sell, so it's per transaction. So it's 0.1% or 0.01% that you have to pay for both the buy and the sell to see the difference. And as long as the margin is high enough, the profit that you get back is larger than the fee that they're charging for the transaction, which means that you're in a plus. And as long as you're in a plus, you have an increase. When you start buying and selling and you're spending more money on buying and selling than what you're making in profits, you have a loss. You're going to notice that as well. But the difference between when you're buying and selling at a loss versus buying and selling at a high, you're going to still end up with a better turnout using trade bots on Bitcoin than what you would trying to watch the stock market all day long on your desktop as a screensaver. Like you see Wall Street guys, the richest of the rich, have like 12 monitors up there with all of the most important stocks on their devices, and they're just watching like a heart monitor the results throughout the day. And as soon as they see a trend, they capitalize on it. News, they pay attention to the news because news impacts sales, which means that if something happens, to a company, or something happens to some of the most important figureheads of the company, that company's value tanks. And when that company's value tanks, the stocks will tank on that company. So if you see that a CEO or somebody is involved in a scandal, that company is going to start losing shares soon. So if you haven't sold, you should probably sell. That's typically how that works. Now, he says, are they going to still be falling? Yeah, they're going to keep. They might go up a little bit after like Tuesday or Wednesday, but they're going to go back down again, and it's going to keep going down. And if you look at the annuals, you will see that it's at its lowest between the third week of March and the first week of May. It's going to fluctuate a little bit, but that's like probably its lowest out of the year. It's going to have one more downtime probably in June, because it's going to deduct some for 4th of July, because like I said, a week to 3 weeks before a holiday, everybody starts cashing out. But after the 4th of July, it's going to be on a moderate increase, short the little bit of a decrease that happens right before school starts. Then it's going to be on a moderate increase. It is going to make it to its highest point in October. So between the second week of September and the first week of October, that is going to be the highest point that Bitcoin is going to be at for that year. And then it's going to start declining again. Typically every year, from wherever its lowest point was, you typically see a 30 to 35% increase on Bitcoin, and then you sometimes see, so you typically see a 50% increase on Bitcoin every year, and then you also see a 50% decrease on Bitcoin every year. That's kind of what you see. So 50 to 75% increase you see every year, and then 50% decrease every year. Now, are they saying like, will the value of one Bitcoin reach $1 million at one point in time? Yeah, it probably will, because the more people that realize that Bitcoin, that cryptocurrency is the next big thing, and the closer that companies start redirecting themselves to digital currency, that's when you're going to start seeing more people actually investing in digital currency, because you can actually utilize digital currency to make purchases across the world, whereas you're limited with transactional currency exchanges in the US. So that's going to be something stock based that you just really got to think about, because you can make a ton of money off of 4% dividends where you don't have to trade. But you can also make, like I said, if you put $20,000 into Bitcoin 2023 in, I think, April, it's like its lowest point between $20,000 and $21,000. And Bitcoin's highest point this year was about $73,000. You would have had a Bitcoin that would have gained you like over $50,000 in 18 months, where you would have made more money. Some people who would have made more money in 18 months off of just putting their money there and letting it hang out for a while than what they make out of a whole year working for somebody else. And if you have the financial capabilities of putting the money in an area where you're making more money back than what you put in there. Travis, wave for me. Oh, that's not an actual Travis. That is an audio file Travis. Nice try, guys. I really appreciate it. And there's the edge of the cell phone. Oh my God, you guys are slick. You guys nothing better to do but to jump onto a live podcast and try to troll a live podcast. And I'm here on YouTube, Twitch, Twitter, and TikTok. So you can see me in different places. But you got to understand, but I am not going to throw you guys in, because unfortunately I have guidelines to put up. You guys have to be grown in order to dive into the podcast, and you are not. So like I was saying, if you can make 50 grand in 18 months, where you're ultimately making about around 40 grand that year, where that's your profit, you could reinvest your profit in. If you would have shaved that 50 grand off and then reinvest it back in, back when the Bitcoin values drop, then you're putting in 50 grand when your principal now is going to be, instead of it being 20 grand, now your principal is going to be, you took 50 off the top, you're going to put your 50 back in when Bitcoin is going to be back valued at, I think this coming low is going to be about 30, 35. And if that was the case, when you put 50 back in on top of your 20, when the value of Bitcoin is at like 40, you're basically buying 1.5 Bitcoins at that point. And that 1.5 Bitcoins, where each Bitcoin would be worth 40, you would probably be pushing your bit. Well, you probably actually be really, because you're putting 50 on top of 20, you'd probably be buying 1 3/4 Bitcoins. But either way it goes, when it doubles, the value doubles, you would go from 1 3/4 Bitcoins to 3.25 Bitcoins, which means that you would end up, each one of those $40,000 Bitcoins would give you like 120, 140 grand. When you're dealing with stuff like that, now you're making more money off of Bitcoin every year than what most Americans make every year. It's not just making more money than a working class. You're actually making more money than the average person, because you made 50 on the first time around, and then your 50 went back in, and your 50 made 100 on the second time around, which means that the third time that you do it, your 100 is going to make you 200 or 300. And you do a 10-year plan playing around with Bitcoin, you're going to be flipping millions of dollars. You also have the ability with Bitcoin, if you leave a certain quantity of money in Bitcoin on a regular basis, you would just gain interest off of it being there as a principal, something that foundationally holds the value of Bitcoin, which is going to entice other people to buy and sell off of your values. So you can make money twice while keeping a certain level in there, not messing with it, and then still buying and selling the other half, where you're turning over a rapid quantity of Bitcoin. And I strongly recommend that Bitcoin be part of your portfolio. Bitcoin traded I can't say that it should be the only part of your, because you should never put all your eggs in one basket, but I'm definitely going to say that Bitcoin should definitely be part of your portfolio trading. So he said he thinks that it will be December. You're going to ask me, what are the election effects? What will the election affect the economy? The election is not going to affect the stock market per se. It is going to affect the economy in a way, depending upon who gets in the office, and depending upon whether or not they stay true to their word. For example, one person said that you're going to have different tax brackets. Different tax brackets means that you're going to have more money every year to spend. More money to spend means that more people are going to buy stuff. More people buy stuff means that the stocks values are going to increase, because they're going to have an increase in sales. That means that those people who are invested in the stuff that everybody's wasting their money on is going to make more profits. However, inflation is going to happen. Because inflation is going to happen, the price of products are going to increase, because you're going to have a higher demand with a lower supply. That's going to mean that inflation is going to offset the profit margin of those stocks, which is going to cause those stocks to then end up being in a situation where those stocks are not going to be turning over as much revenue, unless you have stocks with dividend appreciation, like we were talking about, growth stocks. So you have to deal about that. The other thing that you're going to be looking at is the other person who was talking about, well, everybody who has a lineage towards the slave trade back in the day, which is everybody with a good tan. We're going to give everybody over $1 million a person because their ancestry was involved in slave trade. Now, let's be honest. If you've got lineage upon lineage, they are not going to give each individual person $1 million. Because if you've got 3 children for a lineage that is supposed to get $1 million, but the parent is still alive, the parent is going to get the $1 million and then divide that $1 million between the 3 kids. But let's say, for the sake, that they're going to actually give each individual person who has lineage to, regardless of if it's a family of 5, all 5 people get $1 million. If that's what they're going to do, imagine $1 million, even, because it was more than $1 million. I think it was like 1.2 or $1.6 million. They were supposed to give each American that is ancestry.com back to the oppression days. Right now, everybody with a dark tan. It's almost like the Native thing, where if you are a certain percentage of blood heritage Native American, that you are entitled to a certain quantity of land and a certain quantity of money from the U.S. government. If they did that, you got to think about, there's about 60 or 70% of the U.S. population that are minorities, because it's not majority population, it is majority authority. And since these individuals have less authority over the country's population because they're part of the 99% that is part of the working class. But the fact is that if they did that, you would be giving probably 100 to 200 million Americans $1 million each. That is billions, if not trillions of dollars that they will be handing out when the deficit is just barely under control. So it's a reckless move. But if they were able to do that, you could only imagine only a percentage, and it's going to be a very, very small percentage of individuals that would actually take that money and invest it so that they could quit their jobs and not have to work anymore. And rightfully so, because if you don't get fired because you're making too much money so that they can hire somebody that has less experience than you so that they can retrain this person and deal with the learning curve and like save money on the workload, they're going to replace you with machines anyway for most manual labor jobs. So if you get that $1 million and you don't invest it, if you make it rain like the music videos, so many of these YNs and LNs that are out here, like the next generation that is out here, these Gen Zs that are just wasting money because they see it in a music video, making it rain in a nightclub and all this other stuff. You guys that are making it rain for prom, or you're throwing money around, and you can tell all the broke chicks because they're the ones that's running up there picking the money up off the ground. People who got money don't have time picking money off the ground because they're making more money as they move than what they would to stop and pick up that money. They'll be making more money to move than what they would be making to stand still. People who got money don't chase money, real. So think about this: throwing money away, wasting money on frivolous things that are not going to turn you a profit, that are not liable, where you can actually invest in those things or use those things as leverage or collateral in something else. Those are going to be the things that are going to kind of hurt your bottom line. But you got to remember that unless this woman tells us that the money that they're going to give us is not considered an earned income, yeah, they slide you 1 point some odd $1 million, and then you get taxed on that $1 million. And if they're taxing you that $1 million, you're going to be in one of those tax brackets where that $1 million is going to cost them to take almost half your money back in taxes, where you're either going to be paying them $250,000 or $500,000 in taxes. And then what are you going to do to keep from having to pay taxes? You're going to donate a percentage of it to charity? What are you going to do? There's literally, like, you're going to end up paying Uncle Sam some invest in your business. What are you going to do? If you invest in your business as a primary shareholder expecting to get dividends from your business, that's probably your best bet, where the whole $1 million is a loss because you invested into your business, or you invested in real estate. And not too many people are thinking about, oh, I'm going to invest in real estate and turn properties. Just start buying a bunch of duplexes and fourplexes and quadruplexes, so that, and it really, I can't even say a bunch, because it's hard to say that if you get an 8 unit or 12 unit, you might spend $1 million on one of those. But you can get you a couple 4 units or something like that, and those might be half millions, regardless of the fact. If Camilla gave everybody $1 million, everybody should be a landlord, because everybody should be able to buy at least one multifamily situation, live in one unit, and then rent out the rest of the units, where you can then take your profits and start investing in more multifamily scenarios. But everybody who's not thinking about that, they're going to waste their money, and then they're going to be broke. And that's going to be the only time in our lifetime that the U.S. government will give somebody an opportunity for financial success. If you don't set yourself up with that meal, you going under. So that is going to be the two ways that the economy is going to be benefited from by, or impacted. I can't say benefited from. They're going to be impacted by the involvement of the U.S. government. So Yep. I did talk about Travis. I also talked about Max. And What company has the highest dividend on the market that is performing the best? So now you're asking me which company is gonna show out the most. Well, that really depends on what kind of company you're looking at. Because when you're thinking about a company with high dividends right now, this month, versus high dividends annually, they're two different companies. When you're thinking about a company with high dividends right now that have a low investment, you're talking about different companies than companies with high dividends and high investments. Because you have some companies where you might have $50 to $100 a share, and the dividends are 5%. You have some companies that are $200 and $300 a share, where the dividends are 5%. You have some companies that are like $1.50 a share that are like 150%. But if it's $1.50 and you're getting 150%, you're really only drawing back like $3 off of $1.50 versus 5% on like $50. See what I'm saying? So when you ask me like which one is doing the most, it's not really the percentage of the dividends, it's the value of the percentage of the dividends. Because the percentage of 5% of $100 is more than 10% of $1. See what I'm saying? 5% of $1,000 is more than 100% of $10, or even 100% of $150. So you really got to look at the values, and that's going to be determined the difference between which one you want to get into, because the amount of money that you have available to buy shares, because that's something that I haven't gotten to yet, because I got to talk to you guys, because you don't just walk in there and just go buy stocks. When you're dealing with stock options, you're literally buying options that are going to come in a different fashion. So when I was just about to talk about the difference between the different sectors and the different sectors of investments, we could just go straight on into the stock options. First of all, your standard stock options are going to have contracts, and these contracts are typically going to have 100 shares in them. So when you're looking at a Bitcoin, or remember, Facebook was talking about like $13.75 or $13.75 per share for Bitcoin. I mean, for Facebook, and you think, oh yeah, that's not that much money. It's $13.75, but they're sold at 100 shares per contract. So you're not buying one stock, you're buying 100 of them. So if it's $13.75 times 100, you're going to have $1,375 to buy that. Now, if it's putting out 10%, you're going to be getting $135 back off of $1,375. But do you have $1,375 to get back $135 a month? And then if they're giving you $135 a month, but they're only going to pay you out once every 3 months, you're going to put up $1,375 so that you can get back almost $600 once every 3 months. You see the difference? So that's one of the things that you really have to pay attention to. And then each one of those option contracts is going to have that 100 shares for the underlying stock that you're interested in. So you're guaranteed to pick up 100. So when you're looking at a $12 stock and you're looking at the fact that you got to buy 100 of those, that's $1,200 for a stock. So those people who are looking at penny stocks are 1 cent per stock with 100 shares in a stock. You're going to buy a $1 for 100 shares. But if you're buying 100 shares of a 1 penny stock, and that stock gains $1 of interest per share, you just made 100 $1 shares, which means that you just made $100 off of $1, which is like 100% or 1,000% return. That's one of the reasons why people can hit it big off of penny stocks. Because if you find a stock that has really, really good interest rates, and that's going to be one of those low value stocks, which are penny stocks, that it has really, really good interest rates, but the return is so low because the investment is low. But if you bought 1,000 shares of an electric company where the value of the stock is like $3 a stock, and you bought $3,000 worth of stock, and then that $3 stock goes up to $10, you just gained $7 a share, and you bought 1,000 of those. Now you got 7,000, and that's your profit. That's the interest earned, and then you could either leave it there or cash it out, whatever you want to do. But that's what you're really trying to pay attention to. So, oh, you got some more comments coming up in here. So would invest in S&P 500 be the best stocks because it's a multiple stocks. You're looking at truth. Yeah, S&Ps are good. S&P 500s are good. Index 500s are good. Those are some of the low index, the low risk stocks that are always encouraged when people are doing a 90-20 stock option. Like I was telling y'all 3 months ago, that if you do a 90-20 where 90% of your stocks are low risk and 10% of your stocks are high risk, or if you did an 80-20 where 80% of your stocks were low risk, which is S&P 500s, and then you have 10% moderate stocks and then 10% high risk stocks, where when the high risk stocks take a dive, your overall portfolio is still in the positive, but when your high risk stocks have a gain, your overall portfolio has a massive gain. So if you have a larger quantity of low risk stocks where you have more guaranteed gains than you have losses, you can take more risks in more moderate level stocks and take more risk in more high value stocks, because the high risk stocks give you massive returns, where your moderate stocks give you moderate returns, and your low risk stocks give you low consistent returns. And a mixture of all of those is really what you need to have a really excellent portfolio to work with. But the difference is that if you're stock trading, daily trading, you have to always be there every day looking at the stock, buying and selling, buying low and selling high. You always have to make sure that get the cell phone pointed at the TV correctly. Dustin Marks. You guys are characters. You guys are characters. But you always have to try to make sure that you're buying low and selling high. And if you're buying low and selling high, then you're able to bring a lot more revenue in. But if you really want something that's going to run and you don't have to focus on it, especially when we start talking about, because daily trading is great to expedite growth in your financial wealth. And you can actually use interest off of something else to put into your daily trading practices, so that if you lose it all, it's not going to hurt you. But if you gain a bunch of money off of it, you're turning over a great deal of profits that you can actually utilize for vacations and expansions and investment capital, where you can invest in other people. You can invest in real estate. You can join conglomerates that invest money, where you guys would be able, where you could put your money up and have your money making money for you. But if you're getting those cash investments where you're investing in stocks and bonds and stuff that is going to turn over guaranteed money, where you don't have to do anything, you just put it up there and leave it alone, that's the kind of stocks that you could put into a trust, where the trust isn't going to do anything except for collect dividends on a regular basis and then distribute those dividends to certain individuals, the beneficiaries. You can get into real estate and own a bunch of stuff where you have a large quantity of collateral, you have a bunch of leverage, and that collateral and that leverage, whether you have a large quantity of interest-bearing dividends coming from stocks, or you have large quantities of real estate and assets that you can borrow against to get cash loans to buy stuff cash up front, and then take the cash dividends and pay on the cash loan, where you bought your car cash up front, you don't own anything, and then because you don't owe anything, you have your vehicle. If you put your vehicle in a different location than all of your assets, you've got a company car that doesn't belong to you, but you use it, and you've got all this money here, and you've got the profits paying off the debt. The debt is a tax write-off. The tax write-off prevents you from having to pay taxes on stuff, including property taxes. And if you connect all of this stuff correctly, you've got more money coming in than what you need, and everything that you touch, you own. And even if you was to put the car in your name, your own personal name, and put it on your own personal car insurance, and you're a beneficiary of the trust, and the trust is paying for your car insurance, you still own everything. So you don't have to worry about having to deal with financiers. You don't have to worry about somebody cutting you off and putting you in a, I see Brian Bloom. You don't have to worry about anyone repossessing your car. You don't have to worry about going out of business or losing your job, because you have so much more money coming in than what you've got money going out. And one of the things that I've said before is that when you're making more money than you have debt, you use money you use debt to avoid your taxes. And if you're using debt to avoid taxes, what you're doing is you're going to buy something that's going to be considered a loss on your taxes, like a brand new car, and that's a tax write-off. Ideally, if you owed the U.S. government $100,000 worth of taxes, and before the end of Q4 you bought a $100,000 car, that $100,000 car is technically free because you had to give that money to Uncle Sam anyway. So if you bought a car with it and now it's a tax write-off, then you don't have to pay taxes. That's one of the things that the rich do. So they're not riding around in a Lambo because they wasted a shit ton of money on a Lambo. They're riding around in a Lambo because the value of that Lambo was the value of money that they owed in taxes that year, because you get a 100% tax write-off. They have 13 Lambos because they had to write off 13 different times. And each time they got them a Lambo. And a lot of them buy these things under the business, register them to the business, put insurance on the business, and they have multiple businesses. So you have one business that might own all the cars, and another business that owns all the houses, and another business that owns all the stocks and bonds and stuff. And you can have all of these businesses put into a trust, where, a matter of fact, the profits from all of this stuff goes in one location. And then if something happens where somebody sues something, whatever they're suing is not going to affect your total cash flow. You're not going to have to pay out something, which benefits you in the long run. So he said, would investing in new companies make you a lot of money in the future? Yeah. If you invest in the right startup company, growth stocks, you can become a shareholder. You can become a venture capitalist, where you are trying to get long-term control over a company and dividend payouts, where you have voters' rights of a company. Now you don't have to work. You just literally tell them what they're going to do with your money. And if you are able to buy into this company where you have a majority share, you're able to really take over this company. So take companies like BlackRock. They are the primary shareholder, where they have the majority share of multiple different companies. So say they take each one of their companies and invest into your product, where you had no cap on the quantity of control that your business gave out. Then that particular individual, we've got him coming up. How you doing, Pops? Your son's been trying to dive in all afternoon. I thought it was funny.
That's why I was going to ask you about. How do we get him interested in investing rather than trying to call and prank your show all the time?
Well, that's why he's on there. I didn't block him. I didn't ban him. He can come in. He can listen to the investments. He can listen to this stuff. And even if he's clowning around just like kids clown in class, if they're listening, they're learning. They started notice in the comment section that they went from inappropriate comments to somebody started asking investment questions. So somebody started catching on.
Oh, really? Well, maybe he's learning something, I mean, he's just into Skibbity Toilet these days. You know about Skibbity Toilet?
Yeah. And the
Yeah.
thing is
The
that,
YouTube sensation, the guy's making 20 million.
But okay, so one of the reasons why Biden was banning TikTok was because TikTok is putting up inappropriate stuff, because that's what people are going after, right? People want entertainment. So Skippity Toilet is going to make millions of dollars because people want to turn their brains off, and people want to run in and watch somebody make a fool out of themselves, watch somebody do something ridiculous and laugh. We look at violence, we look at chaos, but we don't pay attention to the things that matter. So investing is something that matters, because investing builds your future. These kids that are trying to jump on the podcast right now, I let them come, because I mean, they need to be here to listen to it so that they can learn stuff, because they're 12, 13, 14, 15 years old. They're their minds are on entertainment. That was Joe, by the way. I just want you guys to know that's Joe. That's the townhome that I was telling you about, the Airbnb from way back in the day. He's been on the show before. We're gonna throw him back in here again. But Joe, his son comes on a regular basis, and I really appreciate it. One of our good fans, but he likes to troll the show, but he's learning something because he's not just here, we're just skippity toilet. Actually, we're here and we're talking about investing. We're talking about stocks. We're talking about dividends. We're talking about making money, make money for you. If he learns how to do this stuff at a young age, his father can get him trade accounts. He could put a little bit of money in there. He can start investing into some things. He can invest into some cheap stuff, turn some profits off of some cheap stuff. Learn how to do it. By the time he's 18 to 20 years old, he could be a trading guru. Then at 24, he could be a millionaire, and instead of making millions of dollars being punched in the face and having Hot Wheels shoved up your behind, he could actually make millions of dollars paying attention to what changes. So when I was just telling you guys about being angel investors and investment capitalists, venture capitalists, you can find a company, find a business model. If it looks good, and most business models look good if the person knows how to write a business model. But if you find some where the market is needing that particular type of business model, where you can clearly see profits in that particular type of product, you can invest in that product. You can put that product into something that's going to give you some profits, and it could be higher profits than the average market value. But because you invested in a company, you're kind of going to get those tax write-offs. You can even use some of your shares where you can get the tax deductions off of that business's expenses and get equity from the company and have a percentage yield in that company where you're overall going to bring back more money. Because if I invest in your startup and now I can use all of your business's debt as my tax deductions, I am making so much money because that's money I don't have to give Uncle Sam. So if you've got all of this extra money lying around, you can make tons of money with your money just by helping somebody else make money. That's the cost of doing business. People don't think about that. People only think about, I'm gonna get paid for my presence. How much presence do I need to put into making a certain quantity of money? That is all a lot of people are thinking about. And because of that, they're not actually putting forth the effort to try to say, oh, I'm going to make money while not being present. I'm going to make money by knowing somebody who wants to be present. I'm going to make money by paying 5 people to find 5 people to make money for me, where I've got 15 people finding 50 people, where 150 people are making money for me, where I don't have to do anything but sit in a nifty chair and talk about a nifty investment book that allows you guys to make a ton of money. That's what I'm about. See what I'm saying? The hardest part of my day was the internet malfunction. Where the hardest part of some people's day is that Joe Schmo didn't show up for work today, that Ally McBeal called out sick, that somebody got fired. Hardest part of their day is that now they've got to do double work. Even harder, they've got to train somebody and do double work. Even harder, they're understaffed, they've got to train somebody and they've got to do double work. But in no one of those situations are you getting paid extra money for your presence. You're getting paid for your presence. And if you work, they appreciate it. Well, technically they don't. They expect it. Because if they appreciated it, you'd get benefits. The only benefits that you get, especially if you're working in fast food, is they might not sell the food to you. They might let you eat it for free instead of charging you for it when the policy says that they're supposed to charge you for it. As long as their waste is low, they'll let you eat for free because they're allowed to count that as waste. So as long as you tell the boss, hey, I'm going to get a sandwich, the boss can write that sandwich off as waste. That's how they show you appreciation. But you're going to get free food. You're going to work, but you're not going to get extra money to pay your bills. You're not going to get extra days off. You're not going to get paid time off because very few companies are giving out paid time off. And the companies that are giving paid time off are only giving a week's worth of paid time off out of 365 days. So out of 52 weeks, you're only going to get 1 week off, maybe 2. If they're giving you sick days and vacation days, you're getting a total of 3 weeks out of the month off. And that is all you're getting. So that you're expected to be there all the time. And if you put in overtime, they're not going to give you extra. They have a cap on how much overtime. They have a cap on how much vacation time they're going to give you. They have a cap on how much of PTO time they're going to give you. They have a cap on how many sick days they're going to give you. And they also have, when you reach that cap, use it or lose it. So after you max out, at some point, you're going to have to cash out on some of them days, take a couple extra days off, and rework your schedule. But you still got to be present. If you miss too many days from work, you don't have a job. You miss too many days from work, you're going to be getting unpaid leave. But why not make the kind of money that makes enough money for you where you don't even have to get out of bed this week? You could just stay in bed if you wanted to. If you found a nice partner that you wanted to have a honeymoon lifestyle with for a little bit of time, you could do that and be like missing for 2 weeks where you guys are just having this whatever thing going on and you're not missing any money at all. That is the type of stuff that benefits you. See what I'm saying? So when you ask, would investing in a new company make you a lot of money in the future? Yeah, it will if you invest in the right company. Should I invest in? No. So he's asking, and I'm going to put this one up here just because he's asking, and this is technically a stupid question, but he's asking, should we invest in OF because they are recently getting very big and I need to make money back that I spend on that subscription? No, so here's your problem with that particular idea. Okay. Just because you pay into a product doesn't mean that buying stock in that product is going to get you back more money than what you put into that product, because you're only going to get a percentage of profits back. See what I'm saying? So if you're paying $1,000 a month in something, but you're only going to get, say, 5% dividends from the profits, and the profits is not the overhead. The profits come after the overhead. So the expenses are paid, the cost of the platform, the cost of the workers, the cost of tech support, the cost of refunds, all that other stuff. Any licensing that they have to pay for, any insurances that they have to pay for, all of that stuff comes out first. And then whatever 40 to 60% that's left out of that, you might get 5%. That 5% might end up being $600 a month, depending on how many shares you bought. But if you're paying a customer and you're buying into the product and you're paying $1,000 a month, you might actually end up losing an average of $400 a month, because they'll give you back $600 a month, but you're paying $1,000 a month to use the product. So no, it's not a good idea to buy something just because they're starting to get big. They're getting big because morale is low, and individuals with no self-respect and self-dignity or moral compass or ethical mindsets are starting to utilize that as an unethical way to make fast money, because there is a demand for adult attention and adult content, and that demand is being filled. But the fact is that if the Republican Party gets into office, that's going to be outlawed alongside TikTok. So the problem is that while there are a lot more people, not just women, there are a lot more people starting up an OF account where they're doing inappropriate stuff to make money. The fact is that particular type of content will be outlawed, which means it can't be sold. And at some point will not be allowed to be viewed, which means that it's not going to be aired, which means that it's only going to be seen on a dark web, which is going to be less accessible. So those individuals are not going to make the money that they was making last year, or that they're trying to make this year. All of those people are going to have to find something else to do. And that's going to really change the game. That's going to change whether or not, you can even invest in that particular type of stock and make money for it. See what I'm saying? So that all of that makes a huge difference. Like even right now, if you wanted to be a content creator and you wanted to go to TikTok, you really have to tiptoe. If you are a US citizen, you really have to tiptoe into how much money you're going to invest in that particular product, because it costs money to start up a podcast. Believe it or not, you could do it for free, but it's a longer journey to do it for free than what it is that to pay into it and expedite growth. Because in every business, 40 to 60% of your money gets reinvested into the business in order to expedite growth so that you can reach the satisfied level faster. And then when you plateau at that satisfied level, you can start reaping more rewards in a shorter period of time. But you still got to invest. And the fact is is that there's at least 10 states in the US right now that has banned TikTok off the airwaves, which means that you're not going to be able to see it in the App Store. You're probably not going to be able to get a signal from the app. If you're broadcasting from that location, you might end up with some issues if they track it and somebody decides to come and kick your door in because you're broadcasting from a state that has prohibited broadcasting, the same way China has outlawed VPNs. If you go to China and start using a VPN, as soon as they find where that VPN signal is coming from, that person gets arrested and goes to jail because it is a state and federal violation. It's a crime to utilize that particular type of telecommunication in that particular type of location. So while there are still 40 other states that have yet to ban it in the United States, if the full totality of the United States bans it between January 29th and March 15th, that there will be no states that allows it. And if no states allow it, then you're not going to be able to log into TikTok from the US. Your account's not going to be active. You're not going to be able to stream. If you can see other people streaming from other parts of the world, if you're allowed to go dark and log in, you're not going to be able to go live from the US. The platform won't allow it because the US won't allow it. See what I'm saying? So when you start thinking, and that's just TikTok. So when you think about how the US is about to do the same thing to OF, you got to understand that before you start putting your money into something that's about to be shut down. Take Bird scooters, for example. The next best thing with public transportation. They are not allowed in some states because of the volatility of the battery pack. They're explosive. People are throwing them into rivers, everything like that. You can invest in a company and the company makes a lot of money. You can become an employee of the company if you're willing to travel with the company. But consider the fact that if you are not willing to travel with the company and you're reading a newspaper and it's saying, hey, the government, the local government, is not satisfied with the $65 million worth of product that they had to fish out of the lake. 2 or 3 people got hurt from it. Somebody killed somebody from it. When you start hearing this type of news, it's bad reviews towards the product that you operate, which means that you're not going to continue operating that product much longer. Eventually, they are going to basically run you out of town. So you have to remember that it's not a good idea to put your money and investments into something that you know is not continuing to be successful. See that? That's one of the things that you got to remember. Now, we have another question here. Are illegal immigrants able to invest if we make money and refuse to get credit credentials? Can I keep the money and buy homes and assets and bank accounts and stuff? All right, so this is technically a irresponsible question, but I'm gonna go ahead and throw it up there. They're asking me, well, can illegal immigrants buy in the stock markets? No. You have to identify yourselves on most transactional apps. You have to provide identification. If you do not identify yourself, you can't activate an account in order to do business on that account. Most US-based accounts require US citizens to be registered on the account, and if you're not a US citizen, you have to identify yourselves as an American immigrant or non-American, non-citizen of the US. There are going to be some tax laws involved with that, so you will be able to collect some dividends if you do register and identify yourself appropriately on a legal basis. Then, because they're going to tax you, you're going to have to deal with taxes, but you're not going to get any tax breaks. You can buy into real estate because there are no laws that I'm aware of at this point where the U.S. is prohibiting non-Americans from buying land. The same way Japan doesn't really have any many restrictions on non-citizens buying land. But you're not going to get any tax breaks on that because you're not a U.S. citizen. You can file taxes claiming how much money you owe, but typically, if you are a U.S. citizen, you're going to be getting a lot more benefits than if you're not a U.S. citizen. You're going to ask if you're able to invest in BlackRock. Yeah, you're able to invest in anything that's on NASDAQ. And then he's asking, they're making most of their money in equity, and that doesn't seem like the best for investments. Yeah, they're good. Making money off of equity. Okay, do you understand what equity is? Equity is the money. Okay? That is the money. So anything that's making money off of the money that's sitting there, that's a lot of money sitting there. You ain't got to worry about that going anywhere. making money off the stuff, you're only making money off the stuff as long as the stuff is there. If there's no stuff, then you stop making money. Like, for example, you buy into real estate. The reason why real estate is so valuable to you is because if you buy in real estate and then you pay off all of your debts, what do you have? Equity. What can you do with the equity? Borrow against it. That is leverage. So a company that is full of equity, that company has higher value than a company that has no equity. What else do we got here? Will BlackRock ever go up that much? I mean, I'm not really sure how much BlackRock increases, but BlackRock makes a lot of money off of everybody else. So, I mean, it doesn't really matter how much BlackRock goes up because BlackRock's making their money off of everybody else. That makes sense because especially if the Republicans get in office, OF isn't going to be anything. Yeah, so you followed us a little bit. Undocumented aliens using a VPN is a little suspicious. So here we go. So anybody using a VPN is going to be treated as suspicious depending on where you go. But when you're utilizing a VPN, even I use a VPN. When you're utilizing a VPN, you're utilizing a VPN to put your internet on a closed network. Putting your internet on a closed network prevents your internet from being hacked. Preventing your internet from being hacked also reduces your ability to have slower speeds, depending on which VPN you're using. If you're streaming and you're utilizing a VPN, you're probably going to be able to get a better connection than what you do when you don't. But sometimes utilizing a VPN can slow down your service. One of the things that you notice is that on YouTube, there are a lot of podcasts that are restricted access because they are age restricted. And YouTube has this thing where if you have too much adult content on your podcast, that they automatically do not show your content because of this age restricted feature where you have to go in there. You can do it from your cell phone and manually turn off age restriction, and then you can see more podcasts released from a specific podcaster. But if you have a restricted access that you cannot manually change, you have to utilize a VPN to go in there and turn off that restricted access mode so that you can see the age restricted content. And the age restricted content is not nudity or anything like that. It's just something that has graphic content like police violence, protests, violent video games, or adult content with a lot of cursing on there, political views, controversial topics like gender inequality, stuff to that effect, is all going to trigger the VPN, all going to trigger the YouTube to restrict viewership to that particular product. Now, that means that particular podcaster either has to do kid-friendly shows, even though it's supposed to be adult only, to get more views, or that podcaster has to take that hit and still try to scale up and be a adult-only podcast, because in order for you to get monetized, you cannot have age restriction on your content. So it's a catch-22. YouTube is going to age restrict your content, but in order for you to get paid, you cannot restrict your own content to age restrict it, where all the adults will see your stuff, but anybody under the age of 18 won't see it. But YouTube will restrict your stuff where only people over the age of 18 as registered on their accounts, or anyone that has an account that is not looking for adult level content is not going to get to see your podcast. So VPNs actually benefit, because if you want to see something that can't be accessed, because you'll notice that certain shows, even some of my shows, you'll click on it and it'll say that you can't see it because it's restricted access to your network. You've got to go and turn off your restricted access. And it might be YouTube's restricted access. It might be restricted access from your cell phone service. It might be restricted access from your internet service. It might be restricted access from your parents saying, I don't want my kids to look at this particular type of content. But you have to change that restriction in order for you to see all the good stuff. Ideally good stuff. Because the good stuff is stuff that you can't really see on a regular basis. He said, we'll take 2 interactive to go up when GTA 6 releases. Yo, when GTA 6, if I'm holding a PlayStation and GTA 6 comes out, I'm going to have GTA 6 somewhere in my podcast, whether or not I have to air a separate show of me just doing a playthrough of GTA 6 and then do my live podcast in the evening, or I'm gonna do something, because me and GTA, I've been in GTA since GTA first came out. So when GTA 5 was the last one that came out, I was talking about, why don't we have like rolling downloaded content on a regular basis instead of continuously putting out a new generational disc? Why not just give us the ability to add on to the last season? And then I also said, well, shit, why don't we have backstories where you have like DLC conquests where you can just like download a new storyline, like um 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 the Fallen Angels and all that other stuff, the Lord of the Damned and all that other stuff that came out in between GTA 4 and GTA 5. Like, being able to ride around in biker gangs and stuff like that was like a whole side story. Like, why don't we just do that? But if you invest into the GTA stock, you might make you some money. And it is a very high demand game, as he said. He asked me about the person in California who identified themselves and lost about 100,000. I think from investing, and they sued the company for 500,000 because he came up with the case that the company had robbed the person. No, I didn't hear about that. Thanks for the Biden administration. He won the case, so now he has 500,000. Yo, that is wild. I did not know that. That is ridiculous. That is ridiculous. I did not know that they were out there acting like that. He said that he didn't play the early versions of GTA, but he got he got to play 5. Well, if you play 5 and you play 4, you're caught up, because there's nothing that they can do in 6 that wasn't in GTA 5 and GTA 4. And the company wasn't very well established, but it didn't scam him at all. Of course, the company didn't scam him. If he invested in the company and the company didn't do well, your gender has nothing to do with your investment strategy. Nobody's going to say, I don't want your money because of your preferences. They're going to say that I don't want your money because of your affiliations. They're going to say that I don't want your money because it might be promoting something that I'm not supportive of. But they're not going to say that, oh, well, I don't want your money because of what you do behind closed doors. That's got nothing to do with me. Now, one of the things I wanted to get into, because I know that I said that I had a lot of stuff that I want to cover, and we're 2 hours in. And this is one of the things that I want to talk to you guys about, because you see those commercials where the people say, oh, well, if you get with me, I can help you start making money in less than an hour. And they talk about all of these options with trading. And we were just talking about the shares and the contracts and the stock option trading. And with that stock option trading, you have different types of option strategies. One of those option strategies is long calls, where you're buying call options and expecting the stock price to rise. You're basically putting a stock that you own up for sale at a certain value. When the stock market meets that value, somebody's going to buy that stock. You have a cover call. When you're selling a call option, that's when you're selling a stock that you own to generate income. An uncovered call, also known as a naked call, is when an investor is selling a call option without owning the underlying security. So you're saying that you're selling a stock that you don't own. That's an uncovered call. That's a high risk situation, because if in the event that the market actually meets that demand, you have to have that stock. So in order for you to meet that demand, you would have to do what is called a put buy. Now, I'm going to explain that in just a second, but you have long puts, which is buying. Puts is when you're buying something, and buying a put option, expecting the stock price to fall. If it falls to a certain level, you buy that stock. And then you have cash secured puts, where you're selling the put option to potentially buy a stock at a lower price, where it is secured by the money that you have in your account. And then you have an uncovered put, which is also known as a naked put. This is when the investor is selling the put option, where you're selling the offer to buy a stock without holding a short position in the underlying security or enough cash to buy the shares of assigned stock. Now, what happens with this is these particular types of strategies allows you to own stock and either sell the stock that you offer to sell the stock that you have, or offer to buy stock that somebody's selling at a specific value. The person who agrees to that will pay you a premium for offering to sell or offering to buy. That premium you get to keep regardless of how the transaction works out. The strategy is that what people will do is people will overshoot a call option knowing the market won't meet that level. As long as the market is below that call option, you get to keep the premium and you get to keep the stock. If it meets or exceeds that call option, where, let's say, for example, if you have this book, this book is sold at $9.99 for a hardcover book on Amazon. I've got links for it in a lot of the videos that I talk about this book. But if you're selling the book at $9.99 and then the book is now being sold at $11.99, then the person that would have bought it at $9.99 buying at $9.99. If you're selling a book at $9.99 when the book is actually being sold right now for $6.99, somebody will buy it at $9.99, but it stops being sold at $8.99 and then starts being sold at $5.99 because it never made it to $5.99. You never sell the book. That's how calls work. A put is different. A put, if the book is $9.99, if the value of the book drops down to $5, I'll buy it. If the value of the book drops down to $5 or less, you have to buy it. If you say, well, if the value of the book drops down to $5, I'll buy it, and the value of the book drops down to like $6.50, it never reaches that $5, you don't have to buy it. But because you said, I'm willing to buy it, if it reaches $5, they'll pay you a premium. That premium value depends on a lot of factors: the length of time of this particular option, the value of the stock, the percentage margin of the stocks. You've got to know a lot of Greek in order to understand the changes in the market. But being a daily trader, you would be able to use these option trades to help you get money solely off of the premium, regardless of the outcome of the stock. This is a higher risk maneuver because you have a limited risk with spreads, but a large quantity of risk when you don't have the capital to cover a put option. And there's a lot of risk when you're risking a high value stock that could potentially gain more value after you sold it. Now, people, when they're buying and selling stocks, they consider it a loss if you sell a stock that is still gaining value. They consider it a loss if you buy a stock that is still losing value, because they're talking about the value of what you paid versus the continuing change in the market. It's a gain if you bought it low and sold it high, but you shorted yourself if you sold it higher than you bought it, but you could have waited and sold it at a higher value. My mentality is, don't be greedy. If you bought it at 10% and it got to about 70 or 80%, and you sold it, even if it goes up to 200%, count your blessings, because you still made a 70% increase on your transaction minus transaction fees. But for some reason, people really focus more on the loss than on the actual gains. Now, yes, if you think about the loss and you think about the difference between breaking even versus taking an L on all your transactions, and the probability of coming out of it with a even higher profit margin because you learned from your mistakes and you paid better attention to your profit margins, then you'll be able to gain you even more money off of your trades. So now you're going to be trading less, making more money, or trading more and making even more money because you're able to do more trades. And trades, literally, to set up the trade, it takes less than 5 minutes to set up a trade. And it sometimes, if you've got all the presets, you know what you're doing, you could probably get that trade up and going where you get the premium in less than 5 minutes. So when the guy said, yes, you can do this, you can do it in a short period of time, truth is, you still got to have experience though. Places like TD Ameritrade allows for put options, but put options are only available for advanced individuals. You have to show proof of advanced individuals, which means that you have to show that you have knowledge in stocks, which means that you have to be able to have shown history in stock trading. In order for you to show history in stock trading, you have to be a stock exchange broker where you can show that you do this for a living, or you have to actually make a certain number of transactions. Now, a lot of places that do put options, call and put options, option trading, they will tell you somewhere between 300 and 500 transactions, whether you buy 300 to 500 times or you buy and sell 300 to 500 times before they give you the option for puts. If you buy 300 times without selling anything, you own a bunch of stocks, which means that you've got some collateral to lose that they can subjugate from you in order to pay off any debts that you gain. They're not going to take a loss at this. They may offer up to 50% of what you're trying to get, but you're going to owe them. So the fact is that they're not going to secure you with a volatile scenario where you could take a loss and they could take a loss at the same time. They want to know that you know what you're doing. So you are going to have to start trading. In order for you to start making money off of this scenario, you have to first start buying and selling stocks without options in order for you to then start doing the fancy stuff that this one guy was saying. And if you follow his lead, then yeah, eventually you might be able to make that money. But guess what? If you're buying and selling 200 to 300 stock, that's like 6 months worth of work, bro. After you've bought and sold 300 to 600 stocks, you're more than likely going to have enough experience to know what you're doing when you get to the option trading. And that's what they wanted you to do. They wanted you to learn what you needed to learn so that when you did start option trading, you would not be messing up the situation and you would be valuing the money that you're putting into it. Because this isn't like Fortnite where you're taking your parents' trust fund money and putting it into buying a bunch of DLCs. You are taking your standard of living, sometimes, some people are, and turning it into a retirement fund. And that's one of the reasons why it's very important for you to know what you're doing so that you're not throwing your money away. So let's see what else we got going on here. He's got, we had a lot of things come up here. He's like, what would be the worst crypto investment in for the next 10 years? Hey, there's a lot of them that aren't doing that well. Bitcoin is one of the best ones. So you really, instead of focusing on the worst ones, you want to focus on the undervalued ones, and then you want to focus on the high return ones because those are the ones that are going to make you the most capital. So that was a appropriate question. So let's go ahead and throw that up there. So he was talking about that one, and then he doesn't see Ethereum doing that well too far in the future. That's just a prediction though. Now Ethereum is actually crossbred with Bitcoin, so Ethereum is going to do just as good. It's not going to be as a billionaire type stock like Bitcoin, but Bitcoin trades against Ethereum, and when Ethereum gains, Bitcoin falls. When Ethereum falls, Bitcoin gains. So when you're trying to keep the values high, you want to sell your Bitcoin at high points when Ethereum is at its low points. And then you want to sell your Ethereum to Bitcoin when Bitcoin's at its low points. Because while one Bitcoin might be like a million Ethereums, when Bitcoin is valued at 40,000, you might actually be able to take a million Ethereums and buy 2 Bitcoins. And then when you sell Bitcoin, when you sell those 2 Bitcoins to Ethereum, you might earn like 2 million Ethereums. So the fact is that the difference in value between those stocks is the reason why you're trading back and forth. And you'll learn that with the trade bots, because the trade bots are not just, I'm going to buy it and then I'm going to sell it to you. It's the difference between, I own an iPhone and I'm going to sell the iPhone to buy a Samsung, an Android. And then I'm going to sell the Samsung to buy the iPhone. And then I'm going to sell the iPhone to buy the Android. So when the iPhone is more valuable, I'm going to sell the iPhone and buy the cheap Android. When the Android is higher, I'm going to sell the Android and buy the cheap iPhone. And that way I keep turning a profit between the values of these two products, because they're going to change in value. Even if one is always going to be worth more than the other, when it's one of these things, you're still going to have a situation where I'm going to sell high, it's going to be low, and then I'm going to sell low, it's going to be lower than it was, and then when the market shifts again, I still turn a massive profit. So yeah, that's one of those things. He said, I had a few friends of mine in Ethereum, and they did all right. It's up and down, but it's nothing too big. Yeah, it's always gonna be up and down. Bitcoin is a cryptocurrency is always going to be up and down. But if you're just buying and selling it by itself, you're not going to see as much results as if you're doing a Bitcoin, not Bitcoin, but a cryptocurrency exchange. So when you're going from one crypto coin to another crypto coin, with your buying and selling exchange, somebody with 5,000 Ethereum might buy your Bitcoin, and then somebody might be selling 200,000 Ethereum for a Bitcoin. And when you're doing it like that, you're gonna buy and sell until you make enough money to make money for you. And then if you take some of that money and say, well, I'm gonna stop stock trading right now, and I'm gonna tiptoe back to dropping my money into high interest yield dividends bank accounts, I'm now putting myself in a position where I'm gonna make enough money where I'm not struggling. And that's really what you want. You want the kind of results where you're not hurting. You want the kind of results where your money's making money for you. And then you want to be able to do it in a way where you're not going to have to babysit it, because that's still a level of work. When you're doing day trading, you're still babysitting the stock market. You're still babysitting your investment. You can pay somebody to watch your investments for you, but now you got to babysit your investor. You got to call them up and tell them, hey, move this, hey, move that, hey, buy here, hey, sell there. And every time you call them, you got to pay a premium. Or you could put it somewhere and just keep getting dividends on it for the rest of your life. Have your kids getting dividends on it for the rest of their life. Have your grandkids getting dividends on it for the rest of their life. Nobody has to do anything. The stock just has to exist. So what's that one saying in real estate called? I don't remember exactly. It's something like when there's yeah, or something like that. I don't remember exactly. I'm not familiar with that saying either. Would it be good to invest in Lunchy and Prime? I don't know. I don't know. Amazon Prime is doing a good job. So you could always get that. And KSI music labels. I mean, if they have a NASDAQ a NASDAQ stock option, then you can look at those, and you could see what the values of those stocks are, and you can see whether or not they're rising and falling, and whether or not they're doing a good job with turning over a profit. And if they are, you invest in them, and if they're not, then don't. You're looking at the value of the stock versus the percentage increase, and with that percentage increase, you want to see what the dollar amount is of that percentage increase, because $1 with 75% increase is 75 cents, and $100 with a 50% increase is $50. So the difference between getting a 75 cents increase versus even a $100 stock with a 10% increase is making less money than a $1 stock making a 75% increase. And then think about the fact that you're buying 100 shares of those. If you got a $100 stock, you've got 100 shares, so that's $100,000 worth of stock. And if that's a 10% increase, that $100,000 worth of stock is going to give you $10,000, as opposed to your $1 stock with a 75% increase, where you have 100 shares of that. You basically have $100 with a 75% increase, where you're getting $170 back. Now, the other difference is that because it's a dollar stock, if you bought because it is a dollar, you instead of you buying 100 of them for $100, you might buy 100,000 of them for $100,000 because they're dollar stocks. And because that dollar stock made a 75% increase, that $100,000 worth of dollar stocks would get you $75,000 of stock. So it is always a good idea to pay attention to that. So when you are looking at the dollar stocks, the smaller value stocks versus the bigger stocks, you want to make sure that you're going all in on the ones that are going to put out a larger quantity of revenue. So you can buy a lower value, high dividend stock and buy a lot more shares than a higher valued, low dividend stock where you'd have to buy low quantity of shares for the same amount of money. You're looking at the total quantity of return. That's what you're looking at. And the longevity of that type of return, because just because it puts out one good time in November doesn't mean that it puts out every time, every month. If it's giving you a good turnout more months than it has a bad turnout, then your dollar stocks, your penny stocks can give you more of a financial increase than your higher buy-in stocks. So let's just pay attention to that as we're looking at how to invest going forward. So he asked, when do you go live? I go live every night of the week, 9 Eastern, 8 Central, 5 Pacific. See that? Look, Bricko's here all the time. He does every day. So he's saying 7 o'clock. So you're saying that I'm doing it at 7 o'clock. So that means that you guys are you doing daylight savings time? Just daylight savings time, hit it yet? It's supposed to be every night of the week, 9 Eastern, 8 Central, 5 Pacific, until the change in time zones occur, where we either go an hour. I think it's fallback, spring forward. Oh, mountain time. Oh, okay. Okay. Oh, okay. So 7 o'clock. 7 o'clock out there in Utah. 7 o'clock in Utah, 8 o'clock in other areas closer to Chicago, like Kentucky. You're looking at 8 o'clock. Florida, you're looking at 9 o'clock. We originate out of Florida. California, you're looking at 5 o'clock. But we are 7 nights a week, and we're typically try to start on time, but sometimes we have a little bit of an issue because we have like 5 or 7 towers around us, cell phone towers, that are not functioning correctly in the state. So we are trying our best to get those corrected so that we can have better connection. Tonight, we had a really good connection because they rebooted the system and like 20 minutes before the show, and now everything's working the way it's supposed to work. So this is the first time in a long time where we haven't had a lot of lag and drop frames and audio problems. And TikTok apparently aired us the whole time with no lip. We didn't get a lot on there, but we did get a lot on there. So with that being said, I'm actually going to sign out of TikTok before we do anything else. I'm going to say, ladies, as long as the situation doesn't make sense, I'm going to keep asking y'all to make it make sense. So ladies, make it make sense. And then for the rest of you guys that dive on here, TikTok, Twitch, Twitter, YouTube, I really appreciate you guys coming to the show. You guys definitely make the show what it is. You guys are entertaining, to say the least. And not going to lie, even if you aren't old enough to get on the podcast, I do value you coming here and learning something about something when I'm trying to teach something to learn. So you got to, yeah, exactly. He said, I got to get deeper into this. Yeah, you do got to get deeper into this. If, for example, at your age, think about it like this. I've said this plenty of times on a podcast. There's over 8,000 financial institutions in the United States. The majority of those banks right now need money. So what they're doing, they're incentivizing accounts up to about $500 or so. They're giving up to 5% interest on those accounts. Some credit unions are doing up to 7.25%. There is no limit to the number of accounts that you can open. There is no limit to the number of banks that you can do business with. Every time you get $200, you could put it into an account, and that account could make a little under $10 a year of interest off of each one of those accounts. Why is that important? If you make less than $10 a year off of that account, the bank doesn't waste time with telling the IRS. If the bank doesn't waste time with telling the IRS, you don't have to tell the IRS. You're supposed to tell the IRS, but you don't necessarily have to tell the IRS, because when you're telling the IRS, you're telling them any unclaimed assets that you actually made money on. But if you're one of those people that doesn't like to talk, then what nobody else filed a form out and said, hey, I gave this guy money. Nobody's filing that form. It's unclaimed or unreported money. Any unreported money, you can do all kinds of ridiculous stuff with. Start turning over $50,000, $70,000 a year. Now, if you don't care about paying taxes on it, if you want to go for the long haul, you want to max it out, I wouldn't max it out. I would put it in about 80%. If they're telling you that the limit is $500, I would put in $400. And that way, the money can gain money year round, and then I could take out the difference, and 100% of my money would gain interest, because everything below the 5% will gain the 5%. Everything above the 5% will get the market average. And the market average is anywhere between 0.54% and 0.62% interest, which is less than 1 penny a year per dollar that you make, which is horrible, versus 5 to 7% interest a year per dollar, which is 5 to 7 cents per dollar. So when you start looking at $100, you're looking at $7 versus $100, and you're looking at 10 cents. See what I'm saying? So you're not making a lot of money from banks when you're putting them into a savings account. You're not making a lot of money from banks when you're putting it in a money market account, because banks actually borrow against your money and use your money to help them make more money for them. So if they're going to offer you interest-free money, well, not interest-free money, they're offering you interest money that is not going to be affected by inflation, because it's a guaranteed 5% gain. You're going to get a guaranteed 5% gain off of any money inside of that amount. Banks typically protect your money up to $250,000. So millionaires have their money in multiple banks. Millionaires don't have all of their money in one bank, because only $250,000 of it is protected. But when you put enough of your money, when you put $1 million or $10 million or $20 million into a bank, you become a partner with that bank. They do more helping you out with your money when a large quantity of your money is in their control. But if you're just trying to get you some extra money, and you open you a bunch of bank accounts and you're putting a few $100, every time you decide to waste money on something stupid, you open up a bank account and put your money in there. Over time, you will gain a large quantity of interest off of that money. Gaining large quantities of interest off of that money, you can move that money somewhere else. You can also utilize that money as an emergency fund, because it's gaining 5 to 7% interest year round until you are in trouble. Then you can just take all that cash out of all of your bank accounts. You can get yourself a Clio account. A Clio account links all of your bank accounts together. When Clio links all of your bank accounts together, you can actually withdraw the money from your bank account without a service fee from your bank whenever you want to, and then use the Clio debit card to make purchases. The Clio debit card actually positively reports against your credit score, which allows you to boost your credit. You're only paying $15 a month for Clio, but if you're making $75 to $100, $250, $300, $1,000, $2,000 a year, doesn't matter if you're paying $15 a month and you've got 200 accounts that you're watching, where you can literally sit there on your phone and just withdraw $50 from each one of the 200 accounts that you have. And the 2 hours that it takes for you to do that, you would have made more money that day than you would have been able to make trying to move money around somewhere else. And you could just be shaving the interest off. Or you could use that to start paying towards your standard of living. That way you could take your actual paycheck and put it towards stocks and bonds and real estate and interest in Bitcoin, where you can then take that money and set it up into something that's going to give you a regular reoccurring payments. When you start getting more money back off of your investments than the money that you got to put into it, when you start making more money than you got bills, that's when you can say, I can quit my job and stop having to work. That is what we call retirement. They have people that teach you passive income when passive income is not truly passive income. Passive income is when money that you didn't have to work for gets you money. That's passive income, because the money passed through you, went somewhere else, and made money. You did not put any effort in. Residual income. Residual income is what they're not talking to you about. They're tricking you into thinking that residual income is passive income. But residual income is when you put a lot of effort into making money, and then that effort is continuing to pay you money for years to come. If you build a house and they continue to pay you on that house after you built that house, that is not passive income, because you once put days, weeks, months into building this house, and that house is continuing to pay you every month after you built it. That's residual, because you put in effort to build the house. If you inherit the house from your father and that house starts making money, you did nothing. That is passive. There's a difference. So when people give you the false hope of, oh, do this to gain passive income, like drop shipping takes a lot of work. There is nothing passive about drop shipping. You can automate it, but there is nothing passive about drop shipping. There's nothing passive about real estate. There's a lot of residual capital there, but there's a lot of work. You got to find the right property. You got to buy it. You got to fix it up. You got to rent it out if you're going to rent it out, or you're going to sell it. Either way, you still got to pay somebody to watch the property. You got to watch that person watch the property, make sure your money doesn't get stolen. You've got you're micromanaging a lot of stuff. Even if you pay somebody to watch the money and have somebody else watching that person, where there's a bunch of checks and balances in there, you still got a 15, 20 person payroll, where you still got to call somebody at least once a month and be like, hey, what's going on with my money? Somewhere along the line, there's going to be civil litigation. Somewhere along the line, you're going to have to buy lawyers. So there's nothing passive about it. It's residual money. But the idea is that if you put enough money in enough places, you're able to build up enough financial leverage where you can then say, I've got $1 million of Tesla stock. I want to buy this MC Hammer house. You can't do it if you don't have the money to back yourself up. But if you've got the money to back yourself up, you could buy the school that you attend right now. You can buy it, turn it into a private school if you spend enough money on it. One of the reasons why rich people have leverage is because they can pay the owner of the building and then put out the people who rent the building, like Red Lobster. Somebody bought the land that Red Lobster was on and then raised the rent on the property so much that the business had to close down. So they didn't even have to compete against Red Lobster. They just put them out of business by buying the land that the building was on, because they were renting all of their buildings because it was cheaper. Somebody bought the land that the business was on and then raised the rent and forced them off the property, forced them out of the market because they were spending more money on rent than what they were making in profits. That's called a hostile takeover. Or that's one way to have a hostile takeover. But these are the things that you learn in business and finance. And that's one of the reasons why I want you guys to just think about how, you guys dive bomb. I don't mind it. I can't show you guys, but I don't mind it. But I just got to show you guys that, like, there's ways that y'all can make money for you, where you could be rich enough where you could walk into a hotel, be disrespected by the hotel, fire the person that disrespected you, and make a statement that you don't disrespect me. Now, when you walk in that building, everybody bows to you because they know that you own the building. You can become that guy. Or you could become that guy that sees an elderly woman walking down the street and you can buy her a hover around so that she doesn't have to walk. You can be that guy too. But what you're not going to be is a guy that can afford to buy himself something to eat if you're wasting all your money on video games and not investing your money on stocks and bonds and real estate. Bitcoin. Make you some money so that when you're 70, you're not still working on a part-time job. Your 20-year plan at 14 years old will put you at 44. I would say 34, but right now at 14, you got to kind of figure things out and spend the next 10 years learning so that when you're 24, between 24 and 44, you should make it. So last statement, he said, will people be using only crypto instead of cash in the next 10 years? Eventually, yes, they will be, but I can't say 10, maybe 50, but I can't say 10. Cryptocurrency is going to be a dominant source of transactions going forward. They already have the U.S. cryptocurrency right now. They have a thing called rainbow currency that's supposed to be a worldwide currency. They've been talking about that for about 5 years now. BRICS is a new higher power form of capital where 5 different countries banded together to make a currency that combats against the euro and the US dollar. And eventually, even third world countries that have access to the internet are going to be dealing with cryptocurrency, where they're going to do away with paper money soon enough. I can't say that they'll do it inside of the next 10 years, though. But I can say that, yeah, it's going to be a dominant thing, because as you walk around right now, you are starting to see more places say they don't have cash in the building, that it is credit card only. 50% of merchants is doing away with cash as a payment option. And you say, well, it's a U.S. currency, they have to take your money. In a way, but if they don't have cash, they can take your money, but they can't give you any change back because there's no cash there. So with no cash, no change. So you either do an exact payment with your cash or charge it to your credit card. But there's no change. So I'm either going to keep the change or you can't buy the item because I can't undersell it to you because you don't have enough money. And I'm not going to undersell it to you and give you twice as much for the $20 that you gave me. I'm not going to do that. Now, with all that being said, I really appreciate you guys. You guys have been a great sport. Lucas Schaefer, always one of our #1 fans. The rest of you guys that have been coming to the podcast for the longest period of time, I appreciate you guys. Mr. Pibbs been doing a good job of eavesdropping on us. His friend zone girlfriend, I appreciate her. Then you have Red Void. You've always been showing us like a lot of support. We really appreciate you guys. So really appreciate everybody coming in from Twitch, and then everybody else that's looking at us from TikTok and everything. You guys are like we're hitting new strides. We got a bunch of new affiliate products. You know, I would show you the compensator that I got, but unfortunately, you know, if I start talking about firearms, they're gonna start turning off my show. So, but we've got. This is the stuff that I talked about today is partly in this book, but how to do it is in this book. What it is what I talked about today, but how to do it is in this book. And I still got to get Brett Owens. He said he's going to come to the show. I got to talk to, I think his name is Joe, is going to be a CPA talking about taxes tomorrow. I got to contact him and make sure that he's ready to go or reschedule the show because I'm going to make sure that he shows up like Wednesday at 9:00. So we got a lot of things coming up and I want you guys to enjoy it. So I'm going to tell you guys I really appreciate you coming to This and That, where I'm your host, Xander, and we talk about this, that, and everything in between. And you guys, I'm going to see y'all